Welcome to TMS Insights. We're in the midst of the February reporting season. It's always a busy time, Ben, and this has been busier really with the ongoing sort of shakeout in parts of the market as described on the recent insights we did just about 10 days ago. So, but today we want to focus, we'll pivot off that and discuss that, but on what's really going on, because in the end, as we're reminded in any market change, if you can be sure of earnings per share growth over the next 3 years, you'll understand where the share price will go. And the best way to know is from the reports.
Yes.
And the reports coming through are offering us a lot of insight.
Yeah, look, the reports, I'd say the market reaction, every reporting season, it feels like it's more dramatic and maybe a bit more illogical in the short term. And we've seen even, a number of companies that we haven't really looked at, and I call out things like AMP last week, which fell 30% on a slight margin miss. Temple & Webster was another
massive
one like
that.
And Nick Scali was a company I've always had a high regard for, who's on the back of a slightly softer January start to the year, fell 20%. So this computer-generated trading, and it doesn't take a lot, particularly in an environment like this, to unsettle some nerves, has become a feature of reporting season, which can be a bit frustrating.
It can be frustrating. It's just got to be understood, though, hasn't it? Because
it does.
Don't be surprised. It does. 20% moves are more common. It doesn't change the long-term nature of a business. You've just got to know it. There's no simple shortcut there. You've just got to know the businesses. And so let's get into a few, Ben, because, as I said, there has been some mixed reports. Let's talk Macquarie, which had an operational briefing. And their last update to us was somewhat of a downgrade. This was okay.
It was good. A lot of focus on the Australian banking component of the business, which is rapidly taking market share from the big four, and particularly, I think, from the smaller players, more importantly, as their use of technology and what is a very capital-light banking business where they don't have branches and they don't need to hold
Come back to that term, capital-light later.
We will. So that was, analysts definitely like that. And I think also just globally for the capital markets part of the business, which is the big kind of swing factor year to year for Macquarie, conditions are actually pretty good. And Macquarie Capital, the head of Macquarie Capital, Michael Silverton, spoke about that. And I think that the takeout from it was pretty positive, that this will look like a year where Macquarie gets back to some form of decent profit growth.
Which is good. Now, you mentioned the Australian banking side, which takes us to Commonwealth, which, again, is the big four that reports a half yearly at this time. So we were astounded again. And it had sold down a lot late last year. It had been very high. But good result.
Look, it was better that was a clear beat. And ANZ came out the following day with a quarterly trading update, which was even more impressive. And I think what was the beat? It was on the cost side of the business in both cases. In ANZ, ruthless cost out. In CBA, very good cost discipline, which meant that the margins have held. There is some revenue growth going on. It's not a lot, but it's there. And it surprised the market. The market wasn't expecting it. And we saw in what are very big businesses, some big jumps in those share prices last week. And I guess the question is, the valuations, again, look pretty full of the banks, particularly of CommBank, but it showed last week why. Because it is quality.
And that's black ink. That's what we're talking about. That's the real numbers, and they're going in the right direction. But just not at the phenomenal rate other growth sectors are doing. Let's talk about some of those. Let's talk about REA Group, which has always been a favourite. It's come down a fair bit of late. Its results are down a bit. And Cameron McIntyre, of course, we'll talk about Carsales in a sec, because Cameron left Carsales to join REA, and he's come in at a really interesting time. So comments about CoStar and Domain, comments about AI. I mean, that's dominating every earnings call.
Yeah.
But the overall business is always subject. We know this well. There are fluctuations in its business. So tell us about REA.
Yeah. So, the core business had a period of slightly weaker listing volumes, and they were cycling against a quarter where there were very strong listing volumes 12 months ago. The business still grew well. It's still guided for positive jaws, which is where the revenue growth is rising faster than the cost growth.
Cost was a bit of an issue here.
Costs were a little bit of an issue. The costs were higher, and that feeds back to a lot of stuff that we're going to have to talk about, which is AI. REA, as all businesses need to be, are investing aggressively into rolling out new features and these sort of things. If I'll just give some feedback, because I've listened to quite a few of these calls now. 30 minutes of Q&A from analysts. Every single question was on AI. Nothing on the result. It's suddenly gripped the market's attention.
Yeah.
Since that they've also announced a partnership with OpenAI, and if you now search on ChatGPT for a house in Sydney, it will actually bring up the realestate.com link. So it's signs of how they're trying to deal with it.
This is their first movers. Now OpenAI has moved to a for-profit model.
Yes.
So this is showing some of the upside in that business as well.
Yeah.
But also REA got there first.
Yeah, it did. So the question the market's got is, could it be disrupted by AI? And I think we'll say with a number of these stocks that we've done a lot of reading and listening to, it's extremely hard for me to see the case. Particularly because of the proprietary data that this company owns, that an AI model can't go and scrape and replicate what REA are doing. And that's the thing I think that is misunderstood. Some businesses are susceptible to that, others aren't.
Carsales isn't. That's another case of a company which has got such an embedded position. And what's attractive here is the lower cost of the item.
Yes.
So there are competitors, but it's not a real threat.
Yes.
In the same way.
Yeah, absolutely. And, dominant marketplace. I think the other thing you call out, Carsales has made a much more successful push offshore, where there's stronger rates of growth coming, but it's been the best. South Korea, United States, etc. Cameron McIntyre, he steered that. And so that's what we're hoping in REA, because they are pushing into the Indian market, and I think there's a question mark over that. It's got huge potential, but they're spending a lot of money to be that number one. They still own the number two player in the United States, Realtor, and I think a fresh set of eyes looking at those businesses will be interesting to see what happens.
Fresh set of eyes. So let's move to another big stock. It's been topical for a year. CSL fired the CEO the night before the earnings call.
Yeah. There was
lots of going on.
There is. I mean, it was. I think we said 6 months ago and 12 months ago it was very un-CSL, the results, and this was very un-CSL. And the way that they timed that and handled that, I thought was pretty average. To drop that on the market at 4.05 the day before a result. This is a tricky one, but that Gordon Naylor has come back. He is Mr.
Been an executive director. Again, reminding people, chairman is Brian McNamee, former CEO during its most successful era.
Yep.
So that Naylor-McNamee team should placate the market.
Yeah. Naylor was there before CSL was actually floated onto the market. He was the CFO during the Bearing acquisitions, etc.
Which were transformative.
Transformative. They bought Securus. He went in to run it as CEO, and he turned it around from a $300 million a year loss-making business to profitable in 2 years. So he has serious cred. We don't know if he will be the permanent CEO.
Perhaps not.
Is the question. But he knows the business backwards. Great set of hands there. The thing with CSL was that, interestingly, the two problem childs of Securus and Vifor were actually the best parts of this half year. The Bearing business was the problem child.
It's a commodity too, and it has rise and falls.
It does,
so it's something we know well. What's different now? The forward PE of CSL is around 7.5, I think.
Yeah.
So we're now back to market multiples, really. we're not doing AI in this stock at all,
No.
just for everybody's benefit.
Yeah.
And so it might be easy to give up on this one, but the wrong thing.
And I think the market's worry is the company had a poor first half. It's retained its full year earnings guidance.
Yeah.
That is going to mean a heroic second half needs to come through, because you would hate to see another downgrade from CSL.
No.
But look, that was the time to rebase earnings with a new CEO, and they didn't do it. And they spoke at length about what they're seeing coming through. So I think on a valuation basis, I would say this is a company that still owns world-class assets, but it is not delivering on their potential. And that's what Brian McNamee spoke about.
A couple ones we like. Pinnacle looked good. ResMed again looking good. So overall, some good ones there. An interesting one that's been belted in the market, Prometicus.
Yes, which is a new one that we've been looking at. Well, we've been watching Prometicus for years. $30 to $300 stock in 3 or 4 years. I think one of the best businesses on the market, and founder-led. It's got all the things that we look for. This company slightly missed expectations, and it was all due to the contracts that they've continually been signing up when the cash flow's been hitting the cash flow statement, which
is always delayed.
Which is always delayed. And so the analysts broadly that follow this have said, it really was a great result, 30% revenue growth. But again, Sam Hubert, the founder, had 30 minutes of non-stop AI questions on the call, at which at the end he said, I feel like I'm a wolf howling in the wind, because this is a business that is not going to be disrupted by AI, and there's 5 to 10 very good reasons why. But the market is in this panic mode about anything in that space, and that saw another leg down in the share price. But this is a stock that is trading on the best PE it's traded on in a long time. So it's an opportunity.
And that takes us to a thematic here, which we want to show a graph on screen about. We basically like to invest in business which is capital light, that they require less money to generate a return than a very heavy capital intensive style of business. And we believe over time they do better. Right now, Ben, the relative valuations of those capital light businesses is as low as we've seen at any time except the GFC.
Yeah. So and this goes back to this disconnect we've seen in growth stocks versus the market. And so this chart's from Goldman Sachs. It's looking at global businesses, not just Australian businesses. And what it shows you is the typical premium that non-capital intensive companies have traded at versus capital intensive companies. And what you can see is that, for the last 25 years or so, a 20 to 30% premium has been pretty standard. And you can also see that the premium at the moment is almost zero, because I think this chart was actually put out 4 or 5 days ago. So, and we've seen another leg lower during that period. So,
and why it's good is we talked about all different kinds of companies today.
Yep.
But why you can justify a premium if you don't have to commit the same capital for a return.
Absolutely.
And all companies are not equal, and it's impossible to use a single metric such as a PE to say one is cheap and one is expensive without knowing what they do.
Yes.
So this is why for everybody listening today, we want to give a very good guide. We think these capital light businesses are relatively cheap versus the rest of the market, and that you don't want to run away from that just while there's a bit of concern about a thematic that could end up benefiting most of these companies.
And that's exactly right, Jez. And, everyone talks about quality. I only like to invest in quality companies. There's not a definition of set quality, but this is one of the biggest metrics that a quality, investor would look at is, say, BlueScope Steel. If it invests $1 into its business, might earn $1.08 back on that dollar. And it has to continuously invest to generate growing profits. REA, for every dollar it invests in its business, it gets about a 42% return on that dollar. And on an annualized basis, it just doesn't have that rate of capital intensity that other businesses do. So this is probably one of the biggest metrics of quality, I would say. And
living off your own cash flows rather than seeking the market's cap raising.
Right.
So,
and that's the other thing is capital intensive businesses frequently have to come back to market to keep raising money because they can't fund it themselves, or they have to borrow the money and they have debt. It's in this small part of the market, it's been a pretty brutal period. Yes. I would say this to start this calendar year. A lot of it is illogical. It's not, the results are not matching up against the freak out that we've seen. And one thing a lot of people don't talk about is valuations, and valuations now are pretty compelling.
That's it.
I'd say.
So that should explain quite a bit for everybody. We'll bring today to an end now, and again we'll be back at the end of February with a second update on this reporting season.